Hey everybody! If you thought inflation and interest rates have been high recently, just wait until the federal government has a debt crisis. That is exactly where business as usual is heading, and that's why it's important to understand what actually causes inflation. So in brief, inflation is an overall rise in the price level. Each dollar is worth less than it was before. The federal government creates inflation, and that ripples through the economy. Inflation means that the money supply is growing faster than the economy. It happened most recently because Congress and the White House spent and borrowed way too much, and that pushed the Federal Reserve to expand the money supply, and that drove inflation. So the money grew too fast, the economy grew pretty slow, and the difference is inflation that we have seen and we will be seeing in the years to come. There's a trade-off between inflation and interest that the Federal Reserve is walking a tightrope on, and especially for the housing market, you've got a combination of higher interest rates because of the response to the inflation due to all the spending and debt, and inflated prices because of the interest rates being so low for so long. Let's go a little bit deeper. Milton Friedman, famous economist, said, and I quote, "Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than an output." So it's money versus output. Let's start with output. It's a little bit simpler. Obviously, during the pandemic, we had some constraints related to the pandemic. The virus, people didn't want to be around each other, so it was harder to hire people, to expand capacity. But also, the shift in what people were able to use their money on changed dramatically. People didn't want to be around lots of other people, and so restaurants and movie theaters and bars and sporting events and arts performances and all kinds of things just weren't happening for a while, more or less depending on where you lived. And then when the Biden administration came in January 2021, there was a tightening of regulations, especially for things like conventional energy, oil, natural gas, coal, and lots of other things besides. So what we've seen is that the real growth in the economy, real GDP, which means adjusted for inflation, has been growing pretty sluggishly for the last couple of years. If you look right before the pandemic, in the fourth quarter, October, November, December of 2019, through to the present, it has been kind of lackluster. There was a quick bounce back after the worst of the pandemic. Most of that happened in 2020. There was still some to be done in 2021, but we were definitely recovering by the start of 2021. So that's the real economic growth. That was a factor. The bigger impact was the growth in the money supply. And here we see a unique circumstance where fiscal policy, what Congress and the White House did, dominated the monetary policy. Congress spent about $6 trillion on the pandemic. Here's a chart from the Committee for Responsible Federal Budget's COVID Money Tracker. $6 trillion of federal spending and tax relief during the pandemic. And that was on top of an already growing debt burden. We were already looking at $1 trillion deficit each year. That's new borrowing each year. So that big debt explosion, that was the kindling. And then what really set off inflation was the $1.9 trillion from the American Rescue Plan in March 2021. As soon as it passed, you see inflation kicking off immediately. People anticipated they were going to be getting the stimmies, the checks. And so they spent money that they had saved up in anticipation of that being backfilled immediately, and it was, by the stimmies. And that's when inflation got started. So let's look under the hood a little bit to look at the mechanics. When Congress passes legislation and with the president enacts it, if that legislation provides for spending and it doesn't cut other spending in real time or raising new revenue in real time, the difference has to be offset or covered by new borrowing. The Treasury Department does keep cash balances to buffer surprises from Congress, but also in anticipation of legislation being passed, they will, do some auctions of debt to build up their cash reserves. And then they have to keep auctioning new debt to be able to build up or to replenish their cash reserves. Anyone can buy federal debt. You and I can buy federal debt, but most of it is done by institutional investors and especially by the 24 major financial institutions called primary dealers. They are expected to make markets for treasuries and bid at competitive rates. In other words, to make sure that there's always going to be someone to buy federal debt. The Federal Reserve doesn't buy debt directly from the Treasury Department. It doesn't participate in those auctions, but it has its own auctions where it buys federal debt from others. It's called the secondary market. And then those others have more room on their balance sheets to buy more treasuries, more federal debt. If you look at the Federal Reserve's balance sheet, it more than doubled from right before the pandemic to at the highest level during. It went from right around $4 trillion to over $8 trillion. It bought most of the new debt that was created during the pandemic. So what do you think is going to happen when the Federal Reserve massively increases its reserves and therefore the monetary base? Well, you expect the money supply to go up. It didn't go up by double. It went up by about 42% or as much as 42% because the rate that money turns over in the economy, the monetary velocity, that dropped during the pandemic. Everybody kind of hunkered down, didn't spend as much as before, partly because they just didn't have as many opportunities to spend, but also people were worried. I was worried. My family was worried about what the future might hold. So we kind of hoarded cash, and the Federal Reserve offset that in part. But they did a lot more than they needed to. Why? It could be that they thought that the markets for federal debt were saturated, and they wanted to make sure that the financial institutions would be able to keep buying federal debt so we wouldn't end up with interest rates going up and provoking a fiscal crisis right then and there. Now, a lot of this happened before the American Rescue Plan Act passed Congress and was signed into law by President Biden, but ARP was the straw that broke the camel's back. The Federal Reserve had been keeping the velocity of money down by paying interest on reserves that were held by financial institutions, but the American Rescue Plan Act, $1.9 trillion, all of a sudden flowing into the economy, that was too much. The Federal Reserve lost control. The gap between money growth and output growth, that's what caused inflation. Just too much money chasing too few goods. So businesses had a choice at that moment. They could raise prices to match supply, a limited supply with surging demand, and some of that has happened, or they don't change their prices, and then we get shortages. And we saw a ton of shortages during the pandemic in lumber and baby formula and all kinds of stuff. But ultimately, businesses were just a transmission belt for the inflation that government spending and debt created. We'll come back to the business angle another time. So you can see that the inflation took off in March 2021 with the American Rescue Plan. It slowed as the spending spigot slowed. It never got to be that crazy. The rest of that Congress, even though Democrats retained control, they did keep the spending spigot on some. And then it slowed down even more when Republicans took the control of the House of Representatives after the 22 midterm elections, when they came into office in January 2023. Then there's a lot more contesting of new spending. Now, to keep inflation under control as much as possible, the Federal Reserve had to raise the federal funds rate a lot and quickly, from basically nothing to roughly 5%. There's a range. And this ended up pushing up interest rates on consumer loans as well. If you look at mortgage interest rates, the national average for a 30-year mortgage jumped from, under 3% in parts of 2020 to about 7% this year. So the point is that the federal government caused inflation. Federal fiscal, monetary, and regulatory policy mistakes combined, they created the highest inflation in 41 years. It was kind of like a rogue wave. All these different things came together all at once. Excessive spending and debt were the biggest contributor by far. That is mostly on Congress. Congress's fiscal policies dominated the Federal Reserve's monetary policies. Congress forced the Fed's hand to accommodate all the new spending. DC's inflationary shockwaves rippled through the economy, rippled through businesses, but the private sector didn't create inflation. We will dissect false claims that they did another time. And understanding that Congress and the White House, through too much spending and too much debt, caused inflation is the key to avoiding fiscal crisis in the future and the inflation and disruption that would come from that. We've got to get the spending and debt under control, and we need members of Congress who are able and willing to make those connections and do what needs to be done. So, on that happy note, until next time, please do like and subscribe.